There's been a lot of discussion at and around the Fed over the last few months about the timing of liftoff when you start raising short-term interest rates.
Right.
In particular, this conversation has been driven as unemployment is falling in the United States and the job market is getting better. Can the Fed be raising rates at a time when there's so much downward pressure on inflation in the rest of the world? We talked about Europe, we talked about China. Japan is also trying to get out of its deflationary funk. What do you do in a situation where the job market is improving, but there's still downward pressure on inflation coming into the U.S. from abroad?
Well, the question is, what is the impact of foreign slow demand or negative growth on the U.S. economy? There is such an impact, but it's not the main driver of the United States economy. And if unemployment continues to decline, if the labor market continues to strengthen, and if we see some signs of inflation beginning to increase, then the natural thing is to get the interest rate up. I mean, we call it normalization, and it's important to recognize we've almost got used to thinking that zero is the natural place for the interest rate. It's far from it. And furthermore, I think that the first step is very important, but there's a process that is being set off when the first step starts. Interest rates are going to go up. They're going to keep going up for some time, and we need to start thinking as well about what's going to happen in the year and years to come as we go back to a normal situation. We're still far from it. We will be far from it when the interest rate rises for the first time, and there'll be another process of years as we continue to try to return this economy to a normal situation. It's not there now by far.
Well, you laid out one scenario, which is the Fed's expected scenario of inflation moving gradually towards 2% and unemployment continuing to fall. What do you do if unemployment continues to fall but inflation doesn't move, or if it goes down because of what's happening in the rest of the world? Can you afford to let things run a little bit longer at this abnormal state of very low interest rates?
Well, we can do that, and if the inflation is really heading south, we will have to do that. We've said we're data-driven, and if that's where the data drive us, that's what we will do. But the most impressive thing about the U.S. recovery is that it's gone on now for a long time, that the unemployment rate keeps declining. The economy is at a growth rate of somewhat over 2%, 2.25%, 2.5%. We're hoping for 3%. And as that continues, we'll have to face the problem which we really have, which is that productivity growth is way, way down. And that's what's driving the slow growth, and we've got to get to measures which will affect productivity positively.